Hello, everyone. Welcome and happy 2021. It's a new year, lots of new things happening in the market. I'm really excited to bring our new guest on. First webinar of 2021 here at NewView as well. We got quite a few people registered, so we're going to give it a few seconds, let everyone jump in, and then we'll go ahead and get started. So today's topic is going to be the passive investor's checklist to securing great investment opportunities. And our guest speaker's name is Ellis Hammond. A few things before he gets started. Here at NewView, we must confess, we are not lawyers, we're not attorneys, we're not CPAs or financial advisors. So we cannot provide you that financial advice or that tax advice. We are very knowledgeable when it comes to self-directed IRAs. Another thing, we do not endorse any products or investments. It's up to you to do your own due diligence. And that's definitely something that Ellis will be diving deep into about doing due diligence. So this is going to be a great webinar for that if that's something you're looking to learn about. A few other things about NewView. We've been in business since 2003, over 17 years. We've been in operations, and the year went by fast in 2020. So we're almost at 18 years. We actually custody 1.5 billion. We just hit our landmark in December in client assets under custody. And a few other things that I love to talk about is we are simple to do business with. We are available and we're responsive. What does that mean? We actually get graded on our percentage of live people answering the phone. We average at 99%. We shoot for 100, but 99% of the time you will have a live person on the phone anytime you call NewView. We are relationship driven as well. So the best thing about NewView is we're not too big of a company where you have to call in and you speak with a different person every single time. More than likely, you will get to know us by a first name basis, and we can build that relationship with our clients. There's about 50 people staffed here at NewView in our operations building, right outside of Orlando, Florida, and Longwood, Florida. So let me just introduce give you a little background on our speaker I'm really excited about. His name is Ellis Hammond. His investing journey began when he was still a full-time college pastor. And with the goal to create passive cash flow for his family, he realized that investing in real estate could be an incredible resource to help him and his family and many others achieve financial freedom. I've been following him on LinkedIn for a long time now, and he posts a lot of great content, and he's part of a great circle of people that are multifamily investors. He and his wife invested in a duplex in San Diego in 2018, and 9 months later, Ellis co-GP'd on a 144-unit complex in Memphis, Tennessee. Today, Ellis is the founder of Kingdom REI, the #1 mastermind community for Christian real estate entrepreneurs. He also manages his own network of investors who are seeking passive investment opportunities in multifamily apartment complexes across the United States. And without further ado, here is Ellis Hammond.
Thanks for having me. This is a lot of fun. Looks like we've got a great crew on here today. So excited to get in. Thanks for joining us. I want to encourage you. We're going to have a awesome. Hopefully, this will be a very laid back presentation to give you some great information about how to vet and do due diligence on your own if you're looking to use your self-directed IRA into real estate. And so, if you have questions, make sure you're using the chat. We will have a time for you at the end of this 25-minute presentation to answer all of your questions. So definitely want to point you to that. I wanted to throw the slide up. This is me and my wife and our puppy Banksy. And I just love having an excuse to tell everyone I am about to be a dad in 2021. I tell everyone that we could close no deals this year. We could do no business, and it'll be a big year for our family. So really excited to be a future father of our little baby girl. And this is my wife, Hannah, my dog, Banksy. We live in San Diego. However, today I'm in a cafe in Tucson. We have been touring properties and meeting with broker teams all week. And so excited to be here with you all today out of Tucson. My company, let me see if I can control these slides. There we go, is Hammond Equities. We typically work with families and investors between $3 and $10 million net worth who, like I said, are looking to invest or own shares in privately held real estate offerings. And so, what I'm going to talk about today a lot is doing your own due diligence and learning how to vet opportunities. This is really the service that we provide. And so we have a ton of experience doing this, and love real estate. It's just become an incredible vehicle for us to achieve financial freedom, really build wealth, and love being able to help other people do this as well. Just because when you heard my story as a full-time college pastor, no one ever taught me that, there were alternative investment classes outside of the stock market, right? That my financial advisor wasn't showing me. And it really changed my life. And so love being able to help and introduce these concepts to people. And so love being in an audience like this, where you're taking control of your life, of your financial future, and having a self-directed IRA. And hopefully we can really help you figure out how to best use that today as well. So this is our presentation passenger checklist. I love this quote from a mentor and friend, Dave Zook, who says, "You can be conventional or you can be wealthy." And good for you for showing up here today and really investing in your financial future on your own. So excited to chat with you. This doesn't matter to everyone, but I think it is important to just kind of know, who I am, like a little bit of what we've accomplished over the last few years. I was named 2020 Multifamily Investor of the Year by Think Realty. Up against some really great other incredible multifamily operators. And so just love that we've got to bring a ton of value to this space. As was mentioned, I put a ton of content on LinkedIn. We have a community called Kingdom REI, which really serves faith-based operators in this real estate industry. And we provide a network and resources and really a board of advisory team for them. And then most recently was hand selected by an institutional level group called Waymaker. They have just an incredible business model. They've brought in some top industry leaders here in the multifamily space and are working on building the first ever faith-driven REIT. And so I'm going to be working with them, raising a fund over the next 6 to 8 months alongside of them. And so really excited about that opportunity. So that's a little bit about me and kind of where I'm at in this space. And again, we can talk about questions on that later, but let's get in to today and why I'm so excited about real estate. And I don't want to assume that wherever, whoever's listening, that you know what's happening in the market. I want to just have a few slides before we get into, okay, here's the opportunity. Now, what do we do with it? Giving you you're going to leave here today with a couple of things. You're going to leave here with some really good knowledge about what's happening in the world, in America, and how that impacts you as an investor, especially as someone who may be interested in real estate. You're going to leave with confidence in how to really look at deals, really look at private offerings that you might want to invest in. And then third, I'm going to leave you with a checklist, the exact checklist that I use when we're looking at projects, and so that you can have a go-to checklist and how to really use your self-directed IRA. The cool thing is this is mostly for real estate offerings, but I think it actually applies across various different asset classes and investment opportunities. So I think you'll be able to get a lot of value out of this checklist. But like I said, I don't want to assume that everyone is, we swim in this a lot. We're seeing a lot of information and data. And so I try to simplify this to give you an idea of just what's happening. It's an incredible time in our country, an interesting time. I mean, with everything that's going on for sure. But even some of these recent headlines I wanted to pull up for you today, U.S. home sales have risen to a 14-year high. Homeowners are now $1 trillion richer thanks to the pandemic-driven housing boom. Really, if you look at the last recession, and you look at what's happened in light of COVID, they're so different. I'm out in San Diego. We have an historic level of housing supply on the market right now, and so the reason I show you this is to note that there's an incredible need right now for affordable housing. This is really good for you as an investor who's interested in rental property, because as affordability becomes harder and harder, becomes less and less here in the United States, this is driving a huge demand for commercial rental property. And so that was, as you can see from those articles, the other thing is, one of the things that's driving housing prices up so high, and there's less affordability in the market right now is just interest rates are so low, especially residential rates, but we're seeing that on the commercial side as well. So from an affordable housing standpoint, as interest rates continue to stay low, this is, this makes it that the housing prices go up. And again, it's just harder for, millennials, low-income families, typical renters to really be able to buy houses right now, even with low interest rates. And there's just not a supply. But I also think as an investor, this is really good because we're buying commercial buildings at 2 and 3% interest rate. So really, really interesting time in terms of affordable housing and interest rates in the market. And then the other thing that's happening in our country right now is just a huge migration trend. And so it's important about where you're investing and what's happening in our country. I mean, like I said, I'm in San Diego, California, and there are companies literally every single week moving to states like Texas, as you can see on this chart right here, to the Carolinas, to Florida, Arizona. I mean, Tucson has been a sleepy market. We're here this week and just amazed at what's happening in this tertiary market, much less primary markets like Phoenix and Atlanta. And so they're just incredible trends. I mean, literally, our country is shifting in terms of becoming a renting nation and what that means for us as investors. So it's an exciting time for you as an investor to be able to have access to capital through your IRA and be able to invest that at will. In terms of the strength of multifamily, why we like this a lot is, even through COVID, rents have stayed relatively strong across multifamily product. As you can see, this is a company that tracks rental collections across the country, and you can see from this graph that they've been above 90% even through the pandemic. And then, historically speaking, thinking about, why this is a strong asset class, why we like this is, I mean, look at this graph. This is rent growth over, since 1985. And this is incredibly strong graph. I mean, the only dip we saw was in 2010, when we had the Great Recession, but even there it stayed positive. We're in a market right now, Tucson, where we've had the highest rent growth this year at 4%, and that's even through a pandemic. So multifamily continues to be a really strong asset class, a stable, predictable, reliable place for you, for us as investors. And so I want you to be aware of what's out there, because we swim in this and we see this a lot. But again, you're not going to go to your financial advisor and he's not going to be able to show you this type of information, because they don't really get access to it, and they can't really get paid for things like this. And so it's important, it's why it's so important to be at things like this and be able to see what's happening. I call it's like the Matrix, right? Once you kind of take the red pill and you see what's out there, it becomes really exciting, and there's huge opportunities for us as investors. And so I just say, when's the best time to invest? The best time to invest is now. We see that there is going to, of course, we wish we would own more real estate back in 2000, but we're going to say the same thing in 2040. Man, I wish we would have bought more real estate in 2020. And so really, really like this asset class and feel strong about it. And I really do think you should too. And so that really brings us to the meat of our conversation today is, okay, if this is, I want to start looking at real estate deals. I have this IRA account or cash or whatever it may be that you're investing out of. You're looking for passive investment opportunities. What do you need to be prepared for? Because the reality is there are some great alternative investments, right? As that quote said, you can be conventional or you can be wealthy. And so, yes, liquidity is found in the public markets, but man, wealth is built in the private markets. And so if you really truly want to build wealth of your lifetime, you have to be in the private markets, alternative assets like real estate, for example. The problem is, though, is that, it in some ways it can still kind of be like the wild, wild west. There's really no advisor, over your shoulder kind of giving you like, is this the right deal? Is this safe? It's just, there are not as many regulations. There's not as much oversight. And so you as an investor need to be really educated, or really trust and work with someone who is really educated to be able to make a wise investment decision. And so I've created a checklist for me and my company. And I've kind of made it digestible for you as a passive investor to be able to do your own due diligence and have a checklist that you can go through when looking at investment opportunities so that you make the right decision. Because no one likes, the most, Warren Buffett's rules of investing, don't lose money and don't lose money. Right. And so having the confidence to really vet deals that you're looking at is really huge when you get into the alternative and private space, especially in the world of syndication, right? Where we're, private real estate offerings. It's just important to really know the questions to ask. And really that's what this checklist is. And so let's get into it today. I want to start with what I believe to be the most important question, the most important component of vetting and doing due diligence when it comes to anything. And it starts with the sponsor. It starts with the man or the woman who is in charge. And the reason that is because of the things I'm going to show you today, there's kind of three different things: the sponsor or the operator, the market, and then the deal. The truth is, if you have a good sponsor who you trust, who knows what they're doing, who has experience, the rest of these things really can take care of themselves, and you may not need to worry about them as much, because the sponsor, the operator, should be doing the rest I'm going to show you today. Now, I'm going to give you the checklist so you can go check them if you like, especially early on. But the sponsor and who you're working with, who you're partnered with in this is the most important, and really should take the bulk of your time, because once you find a couple folks or one or two folks that you really trust, you really want to do business with, then you may be just fine. And so here are some questions. By the way, you can screenshot this stuff, or I'm going to give you my contact information at the end of this, and I will send you my entire checklist PDF so that you can have and be able to use, even print out on future deals. So you can just kind of sit back and listen or take notes if you'd like, but I'm going to send you all of this, so don't worry. Some of the most important questions, they go without saying. What is the track record of the company? Kind of looking at their track record. Do they have a great online presence? And so that's one of the first things we look at, especially for a new sponsor. I got some red flags here, and I want to make sure to stay focused. I want to speak only to the red flags, but as you can see, there are lots of questions that you could or can be asking. But I think the red flags, I marked them because they're some of the most important ones to be asking. And so for me, as an investor in deals, communication is huge. Now, you have to realize, as a passive investor, you're giving up control in order to be passive. That's the trade you're making. So if you invest passively in one of our deals, you don't get to have control because you're passive. However, though, I do think there's a responsibility between the operator and the investor to communicate effectively. And it doesn't matter how, I've been in deals where the returns are pretty decent, but the communication is so poor that it really is just not worth it. And so I think asking the question, and again, these are questions you can ask to the investor or the operator. You can ask to your fund managers, hey, can you send me an example of what your reporting looks like? And how often do you send that reporting out? At a minimum, we want to see quarterly reports and some type of monthly communication happening. And again, I just think that's helpful for me, especially I am passive in these deals, or you'll be passive in these projects, but I still like to know what's happening. And it just assures me that, man, this operator has their stuff together and they have their reporting in line. And so that's important. Can they pass a background check? Listen, I'll tell you a funny story on why I wrote this is so important. I remember doing due diligence on an operator, and we got face-to-face, and we sat down, and we were going through the deals, and I really liked the projects. And then I finally asked him, said, hey man, if we were to run a background check on you, is there anything that we should be aware of that might come up? And his response was, well, why don't you go run it and come back and let's talk? Let me just give you some advice. If anyone ever answers the question that way, you should run. Walk away, because that's not the answer that you want to get. And I think sometimes just asking that question goes a long ways, and it doesn't mean that they have something on their background that they're not a good operator. A lot of people got hit hard in the last recession. Doesn't mean that they're not good operators. They can't learn from their mistakes, but I like to know, and I like to give them the opportunity to be able to explain that. But if they're unwilling to talk about it, or there's something major there, in this case, this guy had several lawsuits against him that I was unaware of. And because I did go run the background check and we did talk about it. And so, if you have an attorney to really do this, there's some online sites that do background checks, but they're really not good. And you really need to, there's some services you can use, but also attorney may be able to do this for you as well. And what does your gut tell you about the operator? You're going to be in a relationship with this person for, and especially in a private real estate offering, 5 to 7 years potentially. And so, it's just, you want to I want to like who I'm investing with. And so there are a lot of folks that honestly we don't work with because we just don't mesh well together. We don't have the same values or the same principles. And trust me, there are a lot of opportunities out there. You can say no to someone, and if you don't like me, that's fine. I'll introduce you to somebody else. But this is really important. What does your gut tell you about the sponsor? So I spend a lot of time here because I think it's so important to know who you're working with, know their track record, verify it. Verify their track record. I think we have here, do their professional referrals, verify the claims that they've made about their experience, their track record, their background. And so, you may, depending on how much you're going to invest with an operator, will depend on how much work you really do. But if you're going to put $500,000 into a deal, let's say, probably important to know who this person is and how well they work with, with vendor clients. Maybe potentially they would give you contact information to a few of their investors to chat with them and meet their investors and see what their investors say about them. But then also on the management level, even the vendors that they work with, that's the type of due diligence we'll go into. Now, we're bringing a lot more money into these deals than maybe you as an individual investor would do. But again, that's the type of detail you could go into. I do think there is a tension here that if you're, let's say, bringing in maybe a smaller amount into a deal, $50,000, $100,000 into a project, you got to be careful of how much questions you can actually, or how much time you get with the sponsor, because unfortunately, your time is valuable and so is theirs. And they may not have the time to sit down with every single investor and answer, all of these questions. But so pick the things that are most important to you and understand that you are trading up control for, to be passive into the deal, but that doesn't mean you can't ask good questions. And most operators that I've found are happy to sit down with you and go through some of this. So the next thing would be the market. These are some of the things that our company looks at, that we go into, and we have the data. We're looking at trends. I showed you that migration trend report. But as a passive investor, again, you're probably not going to go into all of the detail that we might, but I do think there are big things you can look at. What is the population growth happening in a market? What jobs are coming in to that market? Because you think about multifamily real estate, where there are jobs, there are people moving into that, right? If there are good jobs and people can, typically their incomes are going up. And if people's incomes are going up, they have more money to spend on rent. There's more demand for rentals. And so you want, this is the lifeblood of our asset class, is job and population growth. And so I'm going to show you some resources here in a second. I'll show them to you now. I'll come back up. These are two great resources, datausa.io or bestplaces.net, where you this is free. You can go and look at demographics, job diversity. Typically in a market, you want to see really good job diversity, because if, you're in a market where one company or one even industry owns 25, 30, 40% of that market, what happens if they go out of business? Or what happens if they just decide to move because they no longer like it in that state, or another state offers them better tax incentives, and then they move, and now the lifeblood of your asset or your investment is gone. And so these are great resources for you to go and check and just get an idea of what's the population growth been over the last 5 years. Who are the big companies that are working there? What are the type of people, what's their median income, and typically where are they, what are the jobs, and what is the job diversity in this market? The other red flag I have on here is, what is the crime rate in the area? Trulia.com is a great free resource. You can go type in the address of the property and see what that market looks like. And again, you may like an area. It's okay. I'm not saying we don't invest in areas where there's some crime. But again, if you don't want that, then this is a great place to go check that. Again, your operator, your sponsor should be doing all of this, but it's good to verify, right? And it's good to be educated in the investment that you're in. And so those are some great resources for you. I already said this. Is there a sector of the economy that is responsible for more than 25% of the employment of the market? Again, you can see why that would be important if they were to leave. How many major competitors are within a 3, 5, and 10 mile radius of the property? The best place for this, I had this resource down, I think we forgot to list it, was apartments.com. And that's a free resource. It's a huge listing site for apartments. And so you can go and type in the address and see what's out there, see what the competition is going to be. And the reason why this is important as a passive investor is every real estate operator, every fund manager, they all have to make assumptions in order to give you that projection for your fund. So if they say, hey, this is going to be a 15%, average annualized return, they may be very correct in predicting that, but realize everyone is making an assumption in order to get to that prediction, in order to get to that projection. Now, it could be backed by numbers, but there are assumptions in that model. And so what you're doing and what your job is, I think, as an investor, either on your own or working with someone else, is just to verify those assumptions and make sure that your investment thesis aligns with theirs. And if so, then you may have found a great partner to work with over the next several years. And if not, then that's okay. You need to find somebody else. But you're verifying assumptions. I just want to make that clear. This is what we do as an investor. It's important to me to make sure we're verifying we're on the same page with who we're investing alongside of. And then lastly, we get into property specific. It comes down to the property itself, the loan, the finances. Again, of an experienced operating sponsor is going to be doing a lot of this. But because you're directing out of your IRA, I imagine that you, like me, want to verify some of these assumptions, some of these claims, and you probably want to do a little bit more due diligence. So again, I'll send you this checklist if you reach out to me at the end of this. But here are some of the things we look at: age of the property, when's it been renovated, things like roof, plumbing, elevators, electrical. What percentage of the CapEx budget is going to renovations directly tied to rent yield? So I think knowing where we are in the market cycle and understanding wherever you are in the market, especially in light of COVID-19, stay-at-home orders, we don't really even know what customer demand may look like in 15 months from now. So for me as an investor, looking at deals, even our own deals or deals we're passively investing in, a huge CapEx budget that's renovating big common areas based on things that tenants used to do 24 months ago is really concerning, because that consumer base may no longer want to use the apartment complex like they did 12, 24 months ago, right? The entire world is shifting in light of COVID-19. And so this question is important because you want to see what is the percentage of CapEx budget that actually is going towards things that increase rents or decrease expenses, because that's how we create equity and value in multifamily real estate. By increasing the NOI, that creates new equity into the project and, of course, increases your return as the investor. And so that's why that question is in there. In terms of the loan and financing, again, one of the reasons why multifamily has performed so strong, even in 2008, 2009, 2010, is because most of these assets were backed by long-term fixed financing, and they didn't have to sell because they had cash flow to cover their debt. And so this is a massive, massive part of your investment, because you think about it, the bank is the biggest investor of this deal. It's the biggest component of this project is the debt and financing that they're getting on this. And so again, this should be listing in an offering memorandum in terms of the loan terms. But we typically want to see that there is either long-term debt we're purchasing with, or there's a plan to get to some type of long-term fixed financing relatively quickly in order to just make sure that our investment is safe and secure. And so this is a huge piece of that. There are things like debt service coverage ratio, which essentially just means how much dollar per, typically the bank's going to underwrite anything over at 1.25, which just means for every dollar of debt, there's $1.25 of income in order to service that debt. And so that's something that you can look at and should be in an operating or offering memorandum for you to see. Just shows the conservativeness of this deal, right? If it's closer to 1, then you just know that there's less margin for things to happen in this project. And so the higher that number is, the more conservative that deal may be. And then we get into finances. I don't want to confuse you too much here, but again, you'll have this checklist to go through some of these different finances a good operator is going to, and if you're not an expert in finance, then don't get too lost in this, but it's important to know the assumptions your operator, your sponsor is making when it comes to the financial projections and the finances of this project. And so this is the checklist. Again, I'll send this to you and happy to answer any more questions. Again, you can email me, email me checklist, just put checklist in the subject line and be happy to get this checklist out to you. And of course, I'm available by phone, and in my website is ellishammond.com as well. And happy to jump on a call with anyone who'd like to chat more about this.
Ellis, thank you so much for that checklist. I will definitely be emailing you for that checklist as well. And I'm sure lots of the people listening. If anyone has any questions, feel free to type those in the Q&A section at the bottom of your screen. And we'll go ahead and get started with Q&A questions. Right.
One of the questions I get a lot while we're waiting, unless you have things already, is, how important is track record? What if the track record is early for the investor? Does that mean I shouldn't invest with them? And I just don't know. The answer to that is track record is not everything for me. I do think, though, business experience is incredibly important, more than just multifamily experience, for example, because when you buy large, especially if people are investing their IRA, I imagine they're investing in larger deals. The bigger you go in this business, it really becomes a business than investing in real estate. And so I look for things like that. What's their savviness when it comes to business? And, how confident am I that they can make great business decisions? And so, track record is important, but it's not necessarily like some people might think, the end all be all, in my opinion.
One question for myself, I see a lot of young people like straight out of college or still in college, and they're jumping into this, these multifamily types of investments. And, sometimes it looks like it would be a good deal, but they don't have that track record yet. What are maybe some other questions we could ask somebody like that?
Well, they're probably not going to be able to, they maybe do some small deals, but in order to do larger deals, you can't even buy these properties without the bank will not give you a loan or financing without some type of experience, net worth, and liquidity, right? And so you have to have all three of those components to even be part of this. So typically these young guys are going to have someone on their team that can help them do that. And so I want to know who they're working with, who's their mentor, how involved are they, and what is their track record. I want to know them because they're part of the team, and they're going to be a huge component of how well this investment goes. And so, there are a lot of young, hungry guys. I'm one of them, right? And so I don't say like let's get rid of them, but where's their experience going to come from? Who are they really leaning on? So that would be some questions I'd be asking.
Okay. First question, is this webinar being recorded and available on the New View portal? Yes, it is being recorded. We post all of our educational content on our blog. It will probably be posted by the end of the day tomorrow or first thing on Monday. We just have to do some edits, but it will be available for anyone to rewatch it. Okay, the next question. What are some of the best markets, Ellis, that you are focused on right now?
Yeah, great question. Well, we're in Tucson today. Really liking so far what we're seeing in this market. It's a tertiary market. It's getting a lot from Phoenix. And so anyways, Tucson is a great market. Actually, I shouldn't be telling anybody that, but I'm just kidding. We really like this market a lot. Our fund is focused on what they call the Fine 9 cities. So some of the major primary markets, which are Dallas, Houston, Raleigh, North Carolina, Denver, Colorado, Orlando, Florida. That's where, when we look at how, markets that have performed over the last, really 24, 36 months in terms of rent growth, population growth, job growth, if you really want to make this really simple, follow the jobs, follow the big companies and where they're going, because they've already done the research for you. It's why they're moving there. And so our fund is really kind of tracking that and following that. And so, and working with Waymaker, we have some access into it's harder to get into those bigger primary markets. But again, like Tucson, for example, because Phoenix has done so well, it's really considered a tertiary market, but it's experiencing, finally some really great growth because of just the explosiveness of Phoenix over the last couple of years. And so, great question. And I would say, follow the jobs, look the Amazons, the Googles, where are they going, what's happening. And those would be great places, and then try and find even markets, sub-markets around those to be able to do that.
Okay, next question I have here is, do I assume that since you're listing loans and financing on your due diligence list, you are not getting all the funds to purchase from private investors?
Yeah, great question, Randall. Yeah, that's true. On any of these projects, I mean, we're talking about buying $10 to $100 million multifamily apartment complexes. So the bank, Fannie and Freddie are typically, we're taking a loan on these projects somewhere between 60 and 70% LTV or loan to value, and so typically the model is, the other 30% is that's really what you're raising from investors. Is that other 30 or 40% essentially is what you're syndicating or raising in order to really go purchase these larger deals.
Okay, the next question, what does a decent return on a 5-year investment look like?
I mean, I guess you're asking maybe it's a great question. I would say it depends on what your risk tolerance is. I mean, and what you need, depending on where you're at in life. I think the reason we like multifamily, I'll just answer that, is that there's great risk adjusted returns in terms of, the level of risk and the level of returns that are accessible and available to investors. And so, we're really typically underwriting in the mid-teens in terms of average annual return, and in a somewhere, but we're really want to see our money doubled, our investment and our investors' money doubled somewhere between the 5 and 7 year mark. And so that is, that's that beats the market all day long at 8-9%, right? So again, there are other deals out there that you might be able to find higher returns are, but remember, there's risk. I mean, you invest in Bitcoin right now, you might be able to 3x your money, in a year from now, but golly, the volatility of that currency. And so it's a great question. I think what you're really asking is, what should I be looking for? And, we're really seeing in both of our deals and our funds, it's typically mid-teens or what we're underwriting to, and then something between a 2 and 3x on investors' capital in 5 to 7 years is really what our business model and goal and target is.
Okay, next question. There's a misconception with the exact definition of class of property. Can you clarify if class is related to year of build, a year of rehab, or something else?
Yeah, great question, Carolyn. I do think year matters when it comes to maybe you're more your class A, right? Typically all that's being built right now, just because of cost of construction, is typically class A, newer built. But we in this industry, and again, it depends on who you're asking. So it's a great question because it is subjective. There is no book on what is class C, class B, class A, but when it really, what you're kind of saying there is, what is this going to demand for rent? What's the type of tenant base that we're going to be getting into this apartment unit when we say class C or class B? And so, for example, we're in Tucson this week, where there are 1970s, 1980s vintage style properties that are right now class C, right? Typically bringing a lower income level type of resident. And one of the things that is happening in this market is value add plays. So taking those traditionally neglected that have now become class C properties because they haven't been renovated, and essentially doing the value add, making them class B type apartment communities that will demand a higher, that can demand higher rents. And so year is it is important, but it's not everything. You think about you as a renter, as a tenant. You're typically not asking when you go into the building, hey, what year was this building built, right? You're worried about what are the amenities, how much the rent is, where's the swimming pool, you know what I mean? Like, what are the good restaurants around here? And so, I would say kind of below Class A, year doesn't necessarily matter in terms of kind of the grade, or it doesn't matter, but it's not the determining factor for how we classify grades of property. That's a great question. If you need follow up on that, let me know.
All right. Next question is, how long do you typically keep your apartments, and how do you determine when it's time to sell to get the back end profits for the investor?
Yeah, another great question. It depends on the operator. Again, in everything that we're running right now is typically 5 to 7 years. The reason people sell is because they want to be able to show the back end profit of, hey, we reached 15% IRR, whatever it may be. And that's why, because if you're bringing in investors typically want their principal back, and they don't want their principal in that deal for forever. And so that's really why operators have to sell, is because they have to get investors their capital or their principal back. And so we always, and I would say even in our fund and whatever we're doing, we typically shoot for that 5 to 7 year mark, because again, that gives us enough time in these large projects to execute our business plan. And then, we want to be conservative if we can do it faster and look to get, sell that property more quickly, but the market's not in a good place to be able to do that and timing doesn't work. We want to be able to make sure we have the timeline that we've communicated to investors to be able to extend that. So 5 to 7 years is pretty typical. However, in the last 2 or 3 years, I've seen even in large deals, 150, 200 unit deals, where they'll be out of those properties in 2 to 3 years, just because, again, they can sell it and show investors, hey, we did 17, 20%. The tough thing is that now you as an investor, what are you going to go do with the money? Now you got to go reinvest that money, because if not, it's just going to sit in cash and you're losing 2% a year or 3% a year in inflation. And so I personally, as an investor, yes, I'd like to have my principal back, to invest in new things, but also I don't know if that's also always the best decision, because again, now you got to go and put that in something else. You were already invested into a great asset that's secure, that's giving you cash flow. And so I think that's something to consider, but I hope I answered the question.
Okay, I have a question. This one's coming from myself. Can you do a 1031 exchange in multifamily syndications if you found another, I don't know, investment? Say you sold one and you found another one, and it's, the value's more than what you sold the previous one for. Can you do a 1031 exchange?
Yes, you can. And you can 1031 your proceeds. Typically, if you're raising money from investors, you would have to have all of the investors on board to 1031 that next deal, without cashing anybody out. However, as an investor, you can still 1031 those proceeds into another, limited partnership type project. So yes, you can continue to 1031 that. It is a little bit more complicated if you are doing a syndication structure where you have a GP-LP split, but it definitely is doable.
Interesting. Okay, do you focus on value-added properties?
Depends. Our fund, for example, is not your traditional value-add play. We're looking for operational inefficiencies. We're looking for a low reputation on Google, 3 stars or less. We have some technological capabilities that we can increase rents and decrease expenses by, implementing some things to increase our reputation online. So our fund is actually not a huge value. It's not your traditional 10K a unit, more like 1,000 to or 500 to 1,500, and it's implementing more technology, more institutional level data management. So in that term, it is value add, because we're doing something that's not been on the property. It is adding value to the apartment, but not your traditional moving it from a class C to class B or class B to a class A type value add. However, we're in Tucson today, and we are looking at some heavier value add deals. So I say it depends on the market and depends on the investors we're bringing into the deal.
Okay, this next question, it's a couple of questions here. What's your success/failure ratio? Have all of your offerings returned the initial capital back to investors? Have you had any capital calls, and have you had to reduce or stop investor distributions? So that question, I think you should reach out directly to Ellis, and his contact information is available right there, and he can answer that one-on-one with you.
Yeah, great question. I'd love to answer that. Please give me a call, shoot me an email, and happy to walk through our process with you and track record and everything. Wide open book here.
Okay, what markets have you done due diligence on that makes you not want to buy there?
Anything that ends in California, anything that ends in New York. We really like, just go back to the graph I was showing you, the map I was showing you. Let's see if I can go back to this. I don't think I can anymore. But when we're looking at a market, again, going back to those three main things: job growth, population growth, job diversity, but also, laws when it comes to as a landlord and as a tenant, what are the rights that the tenant has versus the landlord has. And so California makes it very, very difficult to do anything. You don't really own your property in California. The tenant owns your property in some ways, because if you have an issue with them, you can't get them out. And so I live in San Diego, but we invest elsewhere. The same thing in places like we see that in New York. I also really don't like places that are cold. And so, and I even see, you think about migration trends right now, people are moving to warmer states. And so you'll see in all of our underwriting, all of our deals, even our fund, that Sun Belt, kind of draw it from Denver across and down is really where we're focused on, because that's where we see the future of, the renter population in our country really moving to. And so that's what we're focused on.
All right. Are any of your offerings DSTs, or are they mostly LLCs?
Yeah, no DSTs.
All right, fantastic. Well, we're going to wrap up the Q&A. I'm sure there's lots of questions that didn't get answered, but feel free to reach out to Ellis. He will be more than happy to talk to you one-on-one. That's his personal phone number there, his email, and his website. He's got lots of other educational content that he's more than happy to share with you. This checklist was definitely helpful. Thank you again, Ellis. And if you have any questions for myself, feel free to reach me at 407-519-9172. If you would like to download our free e-guide, you can text capital S, capital D, capital I, capital R, capital A to 484848. And please include your first and your last name, and we will get you that free e-guide. That's a great place to get started if you're not familiar with self-directed IRAs. Thank you everyone again for attending, and I look forward to hearing from you, and have a wonderful rest of 2021. We'll see you soon. Bye-bye.